Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. I am back after a 3-week hiatus, 3+ week hiatus really. I took a 3-week vacation to Hawaii. It was awesome. I actually had some of the best chocolate in my life in Hawaii when I met a couple that actually owns 75 cocoa trees out there. They gave me some of the chocolate they just made not too long ago, and it was freaking awesome. So it kind of makes sense to look at a chocolate company right when I come back. Hershey's is a stock that was requested in a comment in one of my videos a couple of weeks ago. If you ever want me to look at a particular stock, just leave a comment down below. I do read those, I do reply to those. So Hershey's, ticker HSY, makes chocolate, makes candy. Lately, they've been making salty snacks as well. They got into that business in 2017. They are down about 16.5% year to date. If you look at their all-time highs that were reached in May of 2023, they're down about 30% off of that number for a variety of reasons that I'll talk about soon, but some pressure on the pricing side, some assumptions that growth will slow down in the future, a repricing when it comes to these cheap CPG players, the idea that some of these weight loss drugs are going to impact their ability to actually sell as many goods as they had in the past. If a lot of people are losing weight, they might not be as interested in chocolate, as interested in candy as they were in the past, because those drugs do temper down your appetite. A lot of those things going into why the stock is down so much. On top of that, when it was trading at 276, that was a 2.5% free cash flow yield. That's a bit rich for something like this, something that's probably going to grow in that 3 to 4% range going forward. Now that it's down into the 180s, 190s, it's kind of in that 4.5% free cash flow yield range. And that's more in line with where they've historically been. So let's look at Hershey's. Again, they make chocolate, they make candy. I don't think Hershey's chocolate is particularly good. I grew up in Europe. Chocolate there is pretty solid. Some of the smaller brands in the United States make really good chocolate, but when you talk about big brand chocolate, whether it's Mars, whether it's Hershey's, Hershey's chocolate bars have like 11% cocoa. That's barely chocolate, but some of the other products are really solid. I'm not a huge candy guy. I'm not a huge chocolate guy in general. I do like dark chocolate, but not really super sweet chocolate. My wife likes a lot of their products though, which again speaks to other appetites, not just mine. She loves Reese's, she loves Kit Kats, she likes Twizzlers. And if you think about the top 6 or 7 candies in the United States, Reese's, Kit Kats, and Twizzlers are right up there. I think Reese's and Kit Kat are actually the top two or top two of the top three, one of those, right up there with M&M's. Kit Kat is actually owned by Hershey's only in the United States. Outside of the United States, it's owned by Nestle, but that's, again, they do have a good market there. So really selling a lot of products here. In 2017, they acquired Skinny Pop. Amplify Brands that owned Skinny Pop moved into that salty snack space. I think they've made a lot of solid acquisitions since 2017, really kind of diversifying their business away from just sweets into salty snacks. Acquired Pirate's Booty, acquired Dots Homestyle Pretzels in 2021, Pretzels Inc., private label pretzels as well. 2021 also saw them acquiring Lily's Chocolate, which is more of a healthier chocolate, however you want to call it, but a pretty good bevy of snacking products, and they call themselves as having the strongest snacking portfolio in this industry, and that's probably pretty accurate. If you compare their results against the other companies that are in the S&P food space, they've grown at double the clip in the last 5 years. Their EPS has grown at like 5x the clip. And you can kind of see, well, if they're growing at 5x the clip on the EPS side, but only 2x the clip on the sales side, they're probably improving margins, which they have been. And the one nice thing about the candy business and the snacks business is that there aren't a lot of private label competitors. Really, there aren't any, because of the brand name cachet that Hershey's and Mars, which own like 75% of the market, carry. They haven't really seen a lot of competition from private labels, and maybe that's changing a little bit, and I'll talk about why that is, but certainly that has been a boon for them because they've been able to pass through sizable increases in prices and improve their margins, and that's really led to solid performance of the stock versus the other companies in the S&P food space. You can kind of see that when this investor presentation was issued, the stock was at 276. It's quite a bit lower than that at this point, but still outperforming the S&P food players. And they are the undisputed leader in the candy space. They're scaling their salty snacks. They're doing well internationally. And like I said, they've done a really good job with M&A. I do applaud management for that. I think some of the acquisitions they've made have been very smart. And this is a good business in the sense that it generates a lot of free cash flow. They use that free cash flow to pay out a dividend, but they also use the remainder of that free cash flow to fund acquisitions without taking on a huge amount of debt, which has been a good thing. And they do buy back shares from time to time, but they haven't done a huge amount of buybacks. So what they've done with these acquisitions is they've really grown that salty snacks business. Skinny Pop was a $200 million business when they acquired it in 2017. Now it's almost $500 million per year. Dots Homestyle Pretzels, really solid growing pretzel brand, almost a third of $1 billion per year. They're scaling these brands, they're growing them. They recently acquired some facilities from Weaver Manufacturing to be able to grow that even more, grow Skinny Pop even more, make sure that they have the capacity to meet the demand that these products have. So what do they do? What do they do as far as their capital allocation goes? Again, business reinvestment is number one. That includes M&A, and I think they've done a really good job with that. Then they pay a dividend, maintaining a dividend payout ratio above 50%. It's really been that 50 to 60% range as far as free cash flow goes. They've raised their dividend about 15% the last couple of years, so really strong dividend growth. They pay about 2.5% at today's prices, but they're certainly going to grow that into the future because they have the capacity to do so given their current payout ratio. They do have some share buybacks. It's been about $300 million per year the last couple of years, and then they're reducing debt after that. And their leverage ratio target is about 1.5 to 2, and they're really in that 1.5x range, so not a huge amount of debt. They maybe have about $4 billion worth of debt against about $3 billion worth of EBITDA, against about $2 billion worth of free cash flow. So really in a good spot there, not a lot of worries there. Looking at their latest earnings, pretty solid growth if you look at Q3, which was after the investor presentation. 11% growth, which seems really good. If you look at their EPS growth, it's about 15%. Again, really, really good. Their cash flow is a bit impacted this year simply because they're making a bit of a capital expenditure investment to increase capacity for confectionaries for their salty snacks as well, and then kind of investing in their digital infrastructure, upgrading the ERP system, etc. I think that's going to be a one-year thing, and their free cash flow margins should go up. You can kind of see 2023 growth is going to be pretty good, 8% growth on the sales side, 13 to 15% EPS growth, which is really solid. So what's really driving that? It's, again, 11.1% growth, but a lot of that is coming from pricing. So they're increasing prices, especially on the confectionery side, by about 9.8% and only seeing about 0.9% in volume growth. So they're pushing through higher prices, which again isn't impacting their volume as a whole, which is a good thing, but that's not going to last forever. In fact, the fact that their prices are so high is causing some of their private label competitors to finally come out and say, we're going to start making competitive candy products at a lower price point because these guys, whether it's Mars or Hershey's or whoever they're referencing, have gotten away with pricing. And Casey's, which is a local convenience store brand, is making their own candy private label products now for the first time in a while. They basically said that, it didn't really make sense before because we couldn't compete on price, but now that their price point is so high, we can get in there and still make money. And in fact, Casey's on their last earnings call specifically referenced their candy as a strength, outselling Reese's, Hershey's, etc. in their own stores. And I think that's certainly a risk for a company like Hershey's because they've been able to get away with really high margins for quite some time. But if they get too far ahead of themselves in terms of their pricing, that's going to cause more private label products to come out and compete with them. And that's going to hurt their margins, going to hurt their growth, etc. They did need to press through some of these pricing increases for a variety of reasons, but the main one being, hey, look at cocoa prices. If you look at cocoa in 2021, it was $2,800 per ton. Now it's $4,300 per ton. A big increase in the last couple of years. Sugar, kind of the same thing. You're talking about, $15 a pound in 2020, 2021, up to $23 a pound as of today. So it's coming down a little bit. Cocoa's coming down a little bit, but certainly a lot of pressure on their cost side. But they're pushing on more than just the cost pressure in order to increase their earnings per share as well. So they have to be careful with that. You can kind of see that 11% increase on the confectionery side, negative 1% volume. shrinking on that end. They are still getting really good volume growth on the salty snacks, but it's still certainly putting pressure on the company. So if you look at the company, the stock is down. However, if you look at the valuation, again, it's kind of getting to a point where it just sort of starts to make sense. You're talking about 4.8% free cash flow yield at this point. When it was trading at 270, it was really way too low at a 2.2% free cash flow yield. Now it's kind of back to a normalized range, which is in that 4 to 5% range, which kind of makes sense for a stock like this. Again, you're talking about 4 to 5% when the risk-free rate was close to zero, but now it's 4 to 5% when the risk-free rate was 5%. So again, this was probably a bit undervalued here. Maybe it's a bit overvalued here. But at the end of the day, I think a company like Hershey's, which has a really good history, you look at their financials, you look at, hey, maybe there's a recession ahead. Does it really matter? Well, no, because Hershey's was able to grow through the 2008 recession. They were able to grow through 2020 and 2021. They were able to grow their net income. They were able to have positive net income. They were able to have positive free cash flow throughout all of those years. They haven't had a negative free cash flow year at all since 2006. And you kind of pay a premium for that. So if I'm looking at a bond that pays 5%, or if I'm looking at a company like Hershey's giving me a 4.55% free cash flow yield with a 2.5% growing dividend that's going to grow into the future, it's appealing from that perspective. So I think 4 to 5% free cash flow yield kind of makes sense. If you look at their growth potential here, you know, they've grown pretty well between 21, 22, 23. A lot of that was some of those acquisitions they made, Dots, Pretzels, some of the pricing strategies that they were able to pass through their customers. But now the expectations are that it starts to slow down. Pricing is kind of tapped out unless cocoa keeps going up, unless sugar keeps going up. They can't just push more pricing through because the private label competitors are going to come in. They haven't been in the space too much yet. But if pricing gets away from Hershey's, that could be a problem. If they start facing a lot more private label competition, that could be a problem because they really haven't. Again, they own almost 50% of the chocolate space, and they don't even make that great of a chocolate bar. So it's really interesting that they do. But they do generate a lot of free cash flow. They can acquire more businesses, and I think that's going to be their strategy going forward. That has been their strategy since 2017. Acquisitions through free cash flow generation, raise their dividend a little bit, acquire more companies, maybe grow at a faster clip than this. One thing to remember is that the Hershey company is controlled by the Hershey Trust, which is a charitable trust developed by the owner, the starter of the Hershey company. It kind of does a lot of charitable work, owns a school, etc. They only own about 2 or 3% of the shares, but they own Class B shares, which have 10-to-1 voting rights. So they control like 80% of the company. So this is not a company that, you know, a third party can come into and say, we need to make changes because the Hershey Trust controls this. So it's like, you have to be comfortable with that. They haven't done anything bad or anything like that. Management here has been very good. I think they've been really good stewards of the company, of shareholders. They've made good decisions, but that's something to keep in mind as a shareholder. If you are a shareholder, I am not right now. Just looking at the stock as somebody who might want to be a shareholder. So we're looking at the company right now. It's trading at a 4.6% free cash flow yield. This is live price. I'm recording this at 106 December 6th. So not a ton of debt. Like I said, $4 million in debt. Some of that is capital leases against $2 billion in free cash flow generation, $3 billion in EBITDA. So that's pretty healthy. They can pay that off without a problem. They have been buying back shares a little bit, not too much. They pay a 2.5% dividend right now. They've grown that at about 15% the last couple of years. I am assuming about 10% growth going forward, a bit more conservative. If I look at their growth, it's going to be about 8% as projected in their earnings, a little bit of a margin pressure due to some of those capital investments I mentioned. Going forward, I'm kind of assuming 4% growth from 24 to 27. I think that could be relatively conservative. They do have some pricing ability to pass through to consumers. They're going to have some volume growth. On top of that, I think they're going to use some of this money to make some sort of acquisition within the next couple of years that will help grow their revenue beyond this. There is some risk from private labels coming in if their pricing gets away from them, but I'm not too concerned about that at the moment until you start seeing it in the earnings. From a cash flow margin perspective, I'm kind of assuming that they're going to get back to kind of their highs in 21, 22, 19, where they can get to that 17.5, 18% range. And I think they can do that relatively easily. So this is a relatively reasonable assumption for me. I'm assuming about 15% of their money goes towards buybacks, which is about $300 million a year, kind of what we've seen in the last couple of years. That leaves about $2.5 billion in free cash flow after dividends after buybacks to use towards debt paydowns or purchases or whatever. And I think that is a pretty good balance sheet, a pretty flexible cash flow position. They're going to be able to do good things with that. I'm assuming about 50% in the 5% free cash flow yield scenario, about 50% in the 4% free cash flow yield scenario. Again, if you want to play with this spreadsheet, just hit File, make a copy. I will link it down in the description below. Disclaimer as always, video is purely for informational, educational, and entertainment purposes only. It is not investment advice. Do your own due diligence. So as I look at this kind of assumption that it should be priced in that 4 to 5% free cash flow yield range, at today's price point, you're talking about an expected return of about 9.3%, inclusive of dividends, inclusive of buyback yield. That's pretty solid to me for a company like this, for a company with this history, for a company that's been as consistent as it's been. You're talking about a dividend payout that's kind of in that 55 to 60% range, depending on the year, depending on the assumptions you make, depending on the growth you see. Plenty of flexibility beyond that to either raise the dividend more, buy things, pay down debt, buy more shares if they find it a good idea to buy back shares. They haven't done too much as far as buybacks go, but I think that's not a bad thing considering where the stock's been priced. You know, if they were buying back shares when it was in the 2.5% yield, taking on debt to do that like some companies did, not fantastic stewardship of money. They actually use that money to acquire companies, to pay out a dividend, to raise their dividend. Not a bad idea. So for me, depends on what I'm looking at as far as a target return. I have a 10% target return here, which is about a 12.5% return with dividends. Gets you a fair value of about $162. Maybe that's a bit conservative for a company like Hershey's, given their history, given how good they are. If you put in 7.5% return here, which gets you to about a 10% return after dividends, it's about an $181 fair value. So pretty close to where we are today. Seems interesting to me, given where the stock market has been in the last couple of weeks, couple of months. Everything's gone up again. Hershey really kind of missed out on that journey. They've kind of stayed flat in the last month or two. Actually, have gone down in the last two or 3 months. So they've missed that rally. You know, certainly some risk here in terms of private label companies coming in and stealing some of their lunch in terms of cocoa and sugar prices being a bit escalated. In terms of maybe if you're afraid of the Hershey Trust having so much control over this stock, that could be a problem for you. For me, that's not really a huge issue. So again, some of these weight loss drugs, is that really going to impact a company like Hershey a lot? Maybe. Are people going to eat less chocolate? Are people going to eat less candy? Are people going to eat less chips and pretzels and stuff like that? I don't know. You know, I think some of that is already reflected in the price. I'm not assuming huge growth going forward, kind of assuming slightly above inflation growth. So maybe a little bit of volume plus the price increases that they're going to get. Not really assuming any use of this excess $2.5 billion in cash. They could take $2.5 billion and acquire a company that's going to give them, you know, a couple $100 million in revenue overnight, basically. So certainly have the balance sheet to do that. I think they're in a pretty good spot. I think the stock is priced pretty fairly. This is a stock I would add to my watch list for sure. I think today's price is relatively interesting. If it gets to 181, it's basically a good deal, a fair value. If it starts dropping into the 160 range, I think that's when it starts getting really interesting, and that's when I would start buying quite a bit. But even at 189, I'm thinking about adding a couple of shares of this stock just to keep an eye on it, just to not forget about it. And then the good thing about Hershey's is because of this company's history, because of the fact that it pays out a pretty decent dividend and that dividend is growing, this is a stock that if I buy it at a fair value being in that 4 to 5% free cash flow yield area, if it keeps dropping, I'm not super worried about it because I'll just, buy more or just kind of sit on it and not be scared that this is going to drop 50%. Certainly it could during a recession if all things go to heck and everything kind of just becomes a turd. Any stock can drop 50% during a recession, but from a safety perspective, this one seems relatively safe. If I were to buy at 189 and it drops to 162, would I start to be worried and scared and panic sell? No, this isn't that type of stock. This is a stock I'd feel comfortable holding and kind of feel comfortable knowing that eventually it would be back up into the 200. So am I a buyer at 189? Nah, it's not a smashing deal. It's an okay deal. Would I be a buyer as it starts falling below 180 into the 170s to the 160s? Yes, this is a company I would love to own at 160, at 170. I'd be okay owning it at 189. That's kind of my take on it. Let me know what you guys think in the comments down below. If you like this video, like it. If you are new here, subscribe. If you are a subscriber, welcome back. Thank you for all the subscriptions in the last couple of weeks, months, etc. I do enjoy making these videos. If you would like me to look at a specific stock, just let me know. I will certainly take a look at it if I know the industry, if I know the company. Let me know what you guys think about Hershey's, this video, etc. in comments down below. Otherwise, have a good day, and I'll see you in another video. Bye!